Hans-Ole, thank you very much for inviting me to speak to this conference today. It's a great pleasure to be here. I can think of few more appropriate places to talk about international markets than here in Istanbul, where as far back as the 15th century, people from across the world have met to do business. At this key junction between Europe and Asia, on the historic Silk Road, the diversity of skills here made the city the vibrant success that we see before us today. And with the creation of its first stock exchange in 1826, Istanbul's key position has made it significant, not just as the financial heart of Turkey, but also as a major urban global centre. Istanbul's success lay, and perhaps still lies, in bringing people together. And it is in bringing people together that the success of financial services lies too, linking people and firms across national boundaries for mutual benefit. 600 years ago, we had the Silk Road, through which valuable commodities passed and were traded. Now we have a global financial economy, where commodities and the financial instruments that support their markets are traded across the world, on stock exchanges and through bilateral agreements. It is clear the successful global financial services sector, a strong and competitive sector, is essential in a modern, productive economy. A strong financial services market joins up buyers and sellers throughout the investment chain, bringing finance to business and opportunities for savers to manage their finances over their lifetime. The efficiency of this chain, linking individual savers to firms seeking capital for investment, is critical to allocating funds to the most profitable investments, providing a mechanism for saving and raising productivity. And by linking corporations together to pool and mitigate risk through the use of derivatives, the financial services sector allows those risks to be managed effectively and efficiently. It helps businesses cope with global uncertainties, as diverse as the value of currencies, raw material prices, and certainly from a UK perspective, the weather. In short, financial markets are critical to us all. And while the crisis has rightly brought a huge amount of public and regulatory attention onto industry, it's essential that we policymakers do not lose sight of the big picture, of what financial markets exist for and how we can make them function better. So first of all today, I want to step back from the immediate challenges that the sector faces and look forward to how we address them. I want in particular to talk about trade and openness. As I mentioned, it was trade that made the city great, as a trading hub between Asia and Europe. And it is free trade that is critical to the success of a thriving global financial sector. Developing a single market in financial services lies at the heart of Europe's commitment to economic reform and can deliver benefits for all of us. A lower cost of capital, new opportunities for firms to access cross-border markets, and a wider range of products competitively priced for retail consumers. All of these, in turn, contribute to raising the competitiveness of the European economy. Working together, we've done a great deal towards fulfilling this goal. MiFID I, for example, has opened up much competition and enhanced trade in equities and derivatives. And UCITS has done the same for investment funds, creating a globally recognized brand. But as we tackle the current challenges faced by financial services in Europe, it's important that we continue the road to completing a single market and not lose the hard-won gains that we've seen as a single market develops. One example that springs to mind is the ECB's location policy, which by forcing clearing houses dealing with large euro-based transactions to locate within the Eurozone, runs completely contrary to the single market. Ensuring that necessary regulation still protects open and competitive markets that are critical to fostering economic growth across Europe is vital to the continued success of all of Europe's financial centres. But the single market is not the whole story. We must also recognise the importance of Europe as a global bloc. This means being vigilant against protectionism in financial services and playing our part in an integrated world economy. It's worth reminding ourselves that European financial services are a powerful force in the international market, accounting for about a quarter of financial services exports worldwide, and responsible for managing just under half of global bank assets. I think it's our job to resist any proposals that seek to raise barriers to European investment in the rest of the world and continue to promote a world of unrestricted global trade. Europe must take the lead in ensuring that as we strengthen the global regulatory framework, we do so in a way that balances stability with the maintenance of global markets, sustaining economic growth. To take a prominent current example, we should be directing a lot of focus on the extraterritorial application of the Volcker rule as currently drafted. There is a significant risk that the rule will restrict US banks from trading non-US sovereign debt, and a risk that non-US banks may be restricted in their ability to transact with US investors. On this, as with similar challenges raised by the risk of protectionism, we should be acting together to preserve our common interest in an unrestricted global market. And to that end, we should also be doing more to push bilateral and multilateral trade agreements proactively to ensure that free trade and prosperity that it brings is not limited to trade amongst European states. Now, I set out in abstract our view on the role of markets, and I've spoken of the need for integration and for openness. But what does that mean for today's agenda? Well, I want to close with 4 thoughts on this, which I hope will provoke discussion today. First one is this: remember the end users. Anyone who's been following the markets regulatory program as closely as I have will be aware of how critical the proposed changes are to end users. Multinational exporters seek reassurance they can continue to hedge complex commercial exposures with customized instruments. Food manufacturers seek comfort that commodity markets will continue to serve their needs. Pension funds and their asset managers seek to know how proposed changes to equity market structure will affect them. Policymakers receive a great deal of visits and representations from the financial industry. It's often our first task to distinguish between commercial interests and the common good. And we should remember that markets are a means to an end, not an end in themselves. That brings me to my second point, perhaps a controversial one in this sort of audience. OTC is not a dirty word. Now, I do believe that exchanges represent the beating heart of European market structure. Their importance in price discovery, efficient allocation of capital, and liquidity generation has been recognized since the early days of financial markets, when over 400 years ago, the very first stock exchange opened in the Netherlands to support its trade in the Far East. And exchanges across Europe have raised capital with some 5,500 firms over the past decade. And there's an opportunity for them to serve a key role in growth and financing of new businesses in particular over the years to come. And I thought Hans Oller's remarks earlier about the importance exchanges have, given the pressures facing banks, is absolutely vital. And it's something we ought to look at more carefully. But I think what sometimes commands attention in regulatory debates is the complementary role played by bilateral dealer markets in serving modern end users' needs. This is particularly the case in bond and derivative markets. It is inherent in the nature of many of these markets that there are a huge variety of instruments available. And in OTC derivatives, the number of instruments is virtually infinite. And as a result of this specialism, the number of potential buyers and sellers of a given instrument may be small compared to that in equities at any given time. And so it is in these markets where intermediaries can play a particularly useful role, stepping in to bridge the gap between buyers and sellers, helping users to hedge their risks and meet their investment opportunities. My point is that exchanges and banks, each performing their role where needed, are both critical to meeting end users' needs. And both sides need to recognize this if we're to have a sensible debate. Now, that's not to say that we should shy away from regulating OTC markets, far from it. We have strongly supported compulsory clearing of derivatives and support the move to increase organised trading using the new OTF category. But policymakers and regulators cannot simply wish away the fact that for the most part, bonds and derivatives are not liquid enough for traditional equity-style limited order book trading. So to portray OTC as a pantomime villain without acknowledging the function it can perform in the real economy is a temptation that must be resisted. Thirdly, I'd like to talk about openness, an issue I touched upon earlier. Our view is clear. Openness is good for Europe. The EU is the world's leading exporter of financial services, with extra EU exports of 60 billion euros, accounting for a quarter of financial service exports worldwide. Foreign investors control a total of $5 trillion of EU assets and invested around 230 billion euros in the EU in 2010. And non-EU investors provided almost 30% of the total investment in EU cross-border securities in 2009-2010. European financial centres thrive not just through trade within Europe's borders, but also through trade outside those borders. But I fear that some of the proposals currently discussed could put this at risk. Whilst there is much MiFID to be welcomed, there are some proposals within this review which threaten to erect unnecessary barriers to trade with third countries. On the basis of the current proposals, it seems that no third country would meet EU rules. So from the moment that MiFID is passed until equivalence decisions are made, it would close European markets entirely to any new third country firm, as well as choking off opportunities for our firms in some of the strongest and fastest growing emerging developing economies. It will not benefit Europe if we cannot trade with a new Japanese securities house, or seek capital from China, or invest in Africa. At a time when we have to do everything we can to attract investment to support the economic recovery, we cannot cut ourselves off from the rest of the world. A fortress Europe must be avoided at all cost, a message I hope that we can all embrace. Fourthly, and finally, a plea. Let's not forget competition. Now, debate rages about the impact of MiFID I, and the abolition of the concentration rule, as Hans Oller said, has led to significant changes to the European equity market structure. Clearly, there are challenges in terms of fragmentation, and these must be addressed. But what is clear is that it has led to real competition in the marketplace, forcing down the cost of trading to the benefit of investors. And one study suggests that this effect may have raised the long-run level of EU GDP by as much as 0.8%. We should be looking to use every opportunity in a post-crisis phase to enhance competition where appropriate, whether we're talking about improved post-trade data in equity markets or more competitive access arrangements in clearing. And in this latter area of access arrangements, initiatives are all the more important given the regulatory movement we see towards central clearing and trading of derivatives. As policymakers in financial services, listening to the arguments on regulatory reform, we're used to asking ourselves the question, cui bono, who benefits? And I have to say that arguments against access, which are principally around liquidity fragmentation, could be interpreted as arguments against incumbents losing market share. The starting point should be that market users are able to decide where they trade and where they clear their business according to their needs. So I've outlined for you my opinions on what industry and policymakers should be focused on, breaking down the barriers, listening to customers, making full use of the options that we have to ensure that this vital global industry can do its work, unhindered by necessary hurdles. If we achieve our goals on how markets can function, then they will fulfill their role. They will be able to help businesses raise the capital that they need to expand, provide the growth that Europe needs, manage risks for end users and market participants alike, and also improve returns for investors, the people who provide the capital that help our markets and our economy function. Thank you very much.
Thank you very much, Mark. Mark have offered to stay for a couple of questions.
Yeah.
So feel free now to raise your hand. Yes, please. I think we have a mic coming.
Katri?
Oh, that's it.
Whoops, there we go. You said the British government supported the organised trading facility concept in the Commission proposal, which I think will undergo changes in the process. But can I just ask you as a general point, does the British government support it in the way that the Commission envisages it as a future-proofing, all-encompassing category that will capture as much as possible? Or would you prefer that it be looked at in terms of the specific platform, be it a voice broker or a single dealer broker, whatever it might be? I think I know the answer, but I just wanted to know.
I think there's a real challenge here, Peter, isn't there? Because what we're seeing at the moment across the field of European regulation is two things happening. One is the response to the crisis, and one is keeping pace with future developments. And I think it's very difficult, I think, to future-proof EU regulations. No one knows how markets will develop in the future. No one knows how technology will change, what products will be traded on markets. So I do think we actually need to recognise the limitations to future-proofing. I can't imagine, much as I'd like to think that MiFID II was the last MiFID, I suspect we'll see 3 and 4 at some point in the future. So we should try to respond to what we're seeing at the moment, rather than necessarily always look ahead to rather than try to encompass everything that might happen in the future.
Thank you.
Gentlemen,
this one down here, Mark.
Thank you. Good morning, Minister. That was a very robust defense and advocacy in favor of over-the-counter trading, opaque trading, also with regards to competition in clearing and full open access to clearing. Are you not concerned, Minister, that both the perception and the reality of such positions really defend the positions of large global banks rather than taxpayers or investors?
Well, I think that what we've seen, and Hans-Ole touched on it in his remarks, is as a consequence of the increased competition that arose from MiFID I, we saw competition between trading venues and a reduction in costs for investors. So I think there is a benefit to investors. And of course, what we're also seeing is further market development. So as a consequence of the G20 commitments at Pittsburgh, we're seeing more a requirement for greater clearing of derivatives. And I think it's important we see competition on clearing as well. And I think that is in the interests of end users to see that competition. But that's not to say that clearing shouldn't be properly regulated. And that's why we support the eventual compromise that's emerged on MiFID. So what we want to see is more competition. We think that's in the interest of end users, but we need to see proper regulation. And I think one of the areas that we will need to increasingly focus on, and EMIR helps us on this, is given the shift of clearing towards clearing houses, is how to ensure we have the right prudential regulation in place, for example, on clearing houses. So I think this is not about defending the interests of any one group, but actually trying to ensure that markets operate properly, that they ensure the liquidity is there, but they also ensure that the costs to investors are kept low. And I think, looking at Judas, I think that might be the last question.
It seems so. So one more time, thank you very much, Mark, for coming and joining us today. Thank you.
Thank you very much.